Yeah. Good evening, ladies and gentlemen. Thank you all for joining us for this Singapore Equity Market Outlook webinar. So today our main topic will be about talking about some of the opportunities, investment opportunities within the Singapore region. So without any further ado, let's just start our session here today. So as always, let's start with the disclaimer over here. Please take note that take a look at this disclaimer. And let's start with a little bit of the global market outlook here. So you can see the year-to-date performance is kind of like um, it was quite positive for most of the market, led by regions such as South Korea, Asian region, we have South Korea delivering more than 30% as of year to date, followed by China, Hong Kong, Brazil. But you can see 70 to 80% of the markets actually delivered positive return and is on track to end the year with another very colorful results. And you can see Singapore alone, it's only in the middle around 12%, but there's considered a lot already with Singapore equities reaching all-time high over and over again. So the next real question is whether can this momentum continue? Are there really more opportunities within Singapore, or are we already at the peak already? So this webinar here, this sharing here today will dive deeper into some of the investment opportunities, what should we look after, and which of the opportunities within the sectors that we can look out for. So now let's start with the sectorial performance here. You can see that the Singapore equities led by the STI index actually gone up with a very record-breaking rally, underpinned by a few factors such as heightened global uncertainty because of Trump's policy has prompted investors to rotate into lower risk yielding generating assets. So this benefiting Singapore equities because they given their defensive profile and a more attractive dividends payout. So the global investors will kind of fled into the region. Additionally, we see broad-based strength across key constituents has supported the uptrend. So with a lot of the names such as key contributions, we have names such as you can see on the table on your right hand side, Singapore Technologies Engineering, Jardine Medicine Holdings, and even Singapore Exchange did pretty well. Even the largest constituent, DBS, also did very, very well for the year. So, despite rising global trade tensions, particularly involving the US tariff, Singapore economy demonstrate also enduring strength. It currently enjoys the one of the lowest baseline tariff, about 10%, which is considerably lower than a lot of their regional peers like Malaysia, like Vietnam, like in Indonesia and Thailand. So although higher US tariff have weaken the global trade and dampen demand for Singapore's link sector, but the country comparative lower tariff exposure enhance its attractiveness as a sourcing alternative. So US buyers and global firms seeking to avoid heavy tariff elsewhere may also actually reroute trade and investment flows into the US. So with strengths in like a lot of those high position manufacturing, Singapore is actually they are positioned to benefit from the supply chain diversification. So this is a rare thing because in the past when we say about supply chain diversification, all we think about it is the peers around Singapore like Malaysia, Vietnam, Indonesia, even Thailand. But because of this strategic advantage that Singapore faces lower baseline tariff, so this could actually they actually could actually reap some benefit from the supply chain diversification, reinforcing its role as a trusted global trade and capital hub. So I believe that you have all joined our previous webinars talking about Singapore outlook. So you have somewhat know what are the macro catalysts already. So today my topic will be more on focusing on which sector, what kind of catalysts we are seeing, and to identify which sector they are likely to perform. So one of the major key drivers of Singapore equities this year is actually the EQDP program. So what is EQDP? Many of you might heard before, but not sure if you actually know what it is. It is the full name is the Singapore Equity Market Development Program. It's a major initiative by the Monetary Authority of Singapore, the MAS, to breathe a new life in the local stock market. So they put in more than 5 billion Sing dollar aimed at revitalizing interest in Singapore listed equities. So the first tranche actually happened in July, which was allocated to JP Morgan, Avanda, and Fullerton Fund Management to seek alternative, actively fund manage fund targets at a wide range of stocks, particularly under research small to mid cap companies. So to complement this initiative, the enhanced grant for Singapore Equity Markets Singapore, which called a GEMS, now offers up to 6,000 per Sing dollar per report per research report, encouraging broader coverage of lesser known SGX listed firm, including pre-IPO candidates. So these measures are actually expected to boost liquidity in small to mid cap segments in the near term, while gradually broadening investors' participation across the market. So as capital and research flow into the undervalued areas, this could actually drive fairer valuations and re-ratings, particularly in fundamentally strong companies but overlooked companies. So this is so when you heard of this, my first my first thinking was like, oh, will Malaysia have this kind of thing, right? It could actually boost our local equity market by a lot as well. So we could continue to hope for this, but currently what we are witnessing is this happening in Singapore, and it's really showing some of the changes towards the Singapore equity market, and it's really actually boosting share prices. So this EQDP program also supports the growth of local and international fund managers, fostering the development of a dedicated Singapore equity strategies. So together, this initiative should enhance market efficiency, generate greater investors' interest. So on the bracket on the right hand side, you can see it's actually some of the things that we believe that some of the criteria that the fund managers choose when they pick what stocks to invest in. So first of it is market cap. So the focus is on the market cap between 500 million to $5 billion Sing dollar. So this is to eliminate those mega cap companies and also some companies that are too small. So and we still maintain it between the mid to small cap companies because they are often overlooked despite offering an attractive combination of characteristics. So the operational stability and track record of larger firms combined with expansions of potential typical of smaller companies, many have moved beyond their most unpredictable growth stages, giving them a more balanced risk and return profile. And next is debt to equity ratio. So we favor company with debt to equity ratio that is below than 1, indicating that equity financing is actually stronger, outweighs their debt. Such structures typically reflect prudent capital management, lower financial leverage, and greater flexibility to navigate through all of the economic uncertainties, economic downtrends, without compromising their growth plans. So next is the return on equity portion. We view positively companies that exceed their 10-year ROE of the STI, which is around 9%. So this benchmark serves as a useful reference for identifying mid to small cap companies to demonstrate comparable effective equity utilization. So next is the forward EPS, the earnings per share growth. So we focus on companies exhibiting strong earnings momentum and robust financial metrics, indicating a potential for sustained performance improvement. So our preference is that their forward 3-year EPS growth to exceed around 10% per annum. It's not too big, but it's actually quite sustainable. That means more than 10% is actually quite good already. So we also recognize companies with credible recovery prospect and clearer identifiable growth catalysts, which would be some of the value added points towards our view. So next is the reasonable valuation. So we look into some of the valuation metrics such as PE ratio, the price to NAV ratio. So then we compare these multiples with a 10-year historical averages to provide insights into how valuations align with the long-term performance and market expectation. So this could help us to identify stocks that are trading at maybe their premium or their discount towards their history norm, and uncover structural undervalued opportunities. Next is homegrown leaders. So recognize homegrown leaders are considered important focuses on of the EQDP program because they play a key role in Singapore equity and support the MAS goal of revitalizing local equities. That means, to put it simple, is that if there's two company, one is that has most of their business outside of the Singapore, and another one is another that focuses on domestic demand, we will put more emphasis on this the domestic demand companies. So next is a strategic sector alignment. So we assess whether these companies operate in sectors prioritized under Singapore's industry transformation maps and the EDB growth plans, such as advanced manufacturing, digital economy, semiconductors, and healthcare. So these industries are the key to Singapore's long-term competitiveness and often benefit from policy support, funding incentives, and structural demand tailwinds. So factors that can enhance growth prospect and investor appeal. So overall, this criteria form a directional framework and a checklist for us to filter some of these companies. And not all shortlisted companies meet every parameter, but each exhibits qualities that align with at least part of the EQDP's potential focus. So the next session here, we'll go into deeper into all of these sectors and also companies. So let's start with the biggest sector in the Singapore market, which is financial sector, more specifically the banks. So banks are one of the largest components of Singapore stock market because mainly because finance is the backbone of Singapore's economy, and its main listed companies are global scale financial groups. You have names such as DBS, OCBC, UOB are the most strongest three banks dominating the Straits Times Index, which is the STI index, and three of them are making up roughly around 40 to 45% of the market capitalization. That's a huge amount, dominated by just three companies. So and that's what makes Singapore known as the global financial hub as well. So these three banks, right, DBS, OCBC, UOB, experienced a strong rally in 2024, and many of them has continued the rally in 2025, with DBS delivered around 10 to 20% year to date. So this momentum has also driven by robust quarterly earnings and positive market sentiment following Trump's return to the political stage, as well as Singapore as a overall faces a lower baseline tariff. So a lot of this positiveness has actually uh, flow into the Singapore markets, and a lot of it has also flowed into these three companies that dominated the index. So fast forward to 2025, uh, things that we believe that all these three banks continue will deliver very strong earnings with greater certainty on their capital management plans to reward shareholders. And all you can see the latest earnings result, right? They continue to post very, very strong results. So the three of these companies managed to mitigate net interest margin compression by employing various strategy to minimize their balance sheet sensitivity to interest rate fluctuations. This strategy includes like managing deposit costs, increasing investments in fixed rate assets, and lengthening their portfolio duration. So you see the latest quarter DBS stood out the most by but able to limit their net interest margin compression because interest rates, the SORA rate has been going down for the Singapore. So you can see it will definitely impact the net interest margin for banks, but the DBS stood out very well at managing it with a compression of just around 9 basis point comparing to the previous quarter, whereas OCBC and UOB saw a larger compression. UOB got see another like 9% drawdown, but OCBC see a much more larger net interest margin compression of 828 basis point. So overall, you can see three of these banks, right, DBS still maintain more than 2% of net interest margin. So this advantage reflected in the bank's and net interest income, which grew around 2% year over year, while OCBC saw a decline of 5% and UOB experienced a smaller decline of around 3%. So DBS success in mitigating the NIM compression may also credited to its ability to expand its commercial book alongside with its loan growth. So as for asset quality, we observe the non-performing loan ratio across the banks, further cementing their status as companies with a robust balance sheet. You can see OCBC has around the lowest NPL ratio of around 0.9%, followed by DBS, although it has declined, but it still maintained at 1%, while UOB is the strongest one. They are at around 1.6%. So next, in terms of the CET1 capital ratio, all three banks actually reported just a slight decline, but it's well above the regulatory requirement, Singapore, of around 10.5% to 11%, including capital buffers. So with a resilient business model and consistent financial performance across interest rate cycles, the three largest banks witnessed a negligible decline in the CET1 ratios. So this reserve would open doors to business expansion plans and strengthening. So strategic acquisition can also boost their asset under management as well as earnings, just like the case of DBS acquisition of Citigroup's consumer banking business in Taiwan, which boosted fee income. Similarly, UOB acquisition for consumer banking system business in Malaysia, which we are familiar with. They also took their Thailand and Vietnam businesses. This has supported its credit card business, secured loans, and wealth management. So also OCBC has also looked towards Indonesia's Bank of Commonwealth, which could further broaden its product offerings and clientele base. So despite the rally in share prices, that they did pretty well in 2024 and as well as the year-to-date 2025, we believe that forward dividend yields for Singapore banks remain attractive. Our projection still indicate that these three banks will sustain a dividend close to 6 to 7% over the next 3 years, far exceeding the 2% of those US banks after withholding tax. So next, while Singapore's headline and the core inflation growth have managed to fall below the 2% since November, we believe that the battle with inflation is not over yet. Domestically, resilient labor market continues to drive wage growth, prompting the MAS to maintain a cautious stance and avoid aggressive easing to prevent resurgence of inflation. Externally, we see persistent US inflation with core PCE holding has fled to Fed to signal slower rate cut. So for those who don't know, Singapore does not, they don't use their interest rate as their main policy tool. It manages a band with the Sing dollar against a basket of currencies to keep their inflation stable. Interest rate in Singapore are largely market determined and follow global trends. So the SGD is highly correlated with USD movements because Singapore is more open economy with deep trade and financial ties. So basically, when Fed raise rates, US dollars typically strengthens, and SGD might be weakened unless MAS allows a stronger currency band. So Singapore interbank rates, the SORA, typically move in tandem with US rates. So mortgages, you saw their mortgage rates, corporate loans, bond yields in Singapore are indirectly affected by Fed decisions. So as such, we believe that with rates are expected to stay higher for longer, vs pre-pandemic levels, because our view to US is that we could see a more higher for longer interest rate, although Fed is likely they will cut their interest rate on the next coming FOMC meeting happening in next week. But we believe that rates could eventually stay higher for longer because inflation will start to creep up after all this the tariff started to materialize. Then this could lead to higher for longer interest rate, and this could lead to Singapore also maintaining their rates higher for longer. But it could see a moderate trending lower, and which could lead to bank faces downward pressures on their NIM, especially if loan growth remains subdued. So we just expect a stable net interest income for banks in 2025. So on the other hand, we see greater growth potential for their wealth management fees because of they could be one of the biggest beneficiaries of the EQDP program because all those money flow in the equity markets. So this could benefit their wealth management's business. So Singapore has earned its status as one of the as a financial office hub since 2018. So the number of single family offices granted tax incentive by the MAS has surged fivefold between 2020 to 2024, bringing the total count to 2,000. And during the year 2020 is just around 400. So MAS has also continued to work towards encouraging more family offices to be set up here through better incentive, like what our Malaysia did to the Johor, Singapore, the special economic zone. So with strong government support, a stable political and economic landscape, and a business-friendly environment, Singapore is expected to remain highly attractive uh, to all those ultra net high net worth individuals, particularly as geopolitical tensions among major power continue to rise. So overall, we expect the net interest income alongside growth in the wealth management fees for to support modest growth for the bank's earnings in 2025. So though the growth outlook for banks appears softer, we view their resilient earnings and substantial excess capital above regulatory requirements as supportive for another strong year in 2025. That means the second half, the remaining few months of 2025, we still expect it to be to the Singaporean banks to be strong. So now let's move on to the broader financial sector. So we believe that some of the companies might, other than those big banks, they can actually reap benefits from the EQDP program. So since its launch, right, the EQDP has catalyzed a visible rotation of investors' interest beyond the traditional banking heavyweights. You can see as of September, year-to-date returns for this yeah for the mid to small cap counters highlighted in the dark blue have surged, underscoring growing investors confidence and momentum within this segment. You can ignore the footnote at the bottom there, there's a typo. So while EQDP aims to improve liquidity and visibility in this under such segment, the impact is unlikely to be uniform. Companies with solid earnings fundamentals and reasonable valuations are more likely to attract fund flows and feature in the EQDP mandated portfolios. To identify the potential beneficiaries, we applied the few screening criteria just like I mentioned, such as market cap between 500 to 5 billion, forecasted medium to longer term earnings growth potential that exceed 10% with reasonable valuation. And with this in mind, right, with this filtering in mind, we believe that UOB Kay Hian actually stands out as the one of the most directly beneficiary of the EQDP program as a US as a Singapore-centric brokerage with approximately 60% of their revenue derived locally, it is well positioned to capitalize on its rising trading activity in the Singapore equity market. Its core businesses is heavily volume sensitive, with brokerage commissions forming a major revenue stream. So increased investors interest and equity turnover alongside with demand for structured program products and derivatives amid heightened volatility and attractive yields can significantly boost earnings. Company has also delivered an impressive CAGR of around 23% for the past 5 years with projected growth of 11% CAGR. So other companies such as you can see in the list is actually we have Yang Zhejiang Financial Holdings. They see modest benefits from the EQDP program because while its core focus remains in fixed income, it is gradually expanding into wealth and equity management. Albeit they are still early, they are still small. And also Hong Leong Finance, with its focus on SME lending and the Pacific Century regional developments, which has exposure to those real estates in Singapore, right? We believe that they have limited direct relevance to Singapore equities or the EQDP related flows. So from a valuation perspective, you can see on the chart on your left-hand side, UB Kay Hian and Hong Leong Finance are actually currently trading close near to their 10-year historical averages, while the others actually like Yang Zijiang Financial and Pacific Century have re-rated above their respective historical means since Yang Zijiang Financial listing in 2022 and based on 10-year data for the Pacific Century. So in particular, Pacific Century's recent price surge appears unjustified given its limited EQDP exposure and a weak earnings record. Overall, UB Kay Hian emerges as one of the most compelling candidate, meeting key criteria of within the mid to small cap range, demonstrating strong historical and projected earnings growth. So clear earnings uplift potential for the EQDP related trading activity fund flow, and they actually trade at quite reasonable valuations. So although big banks like your DBS, just like I mentioned, DBS, OCBC, UOB, they all fall outside of the scope of the EQDP, but they still stand to gain indirectly from a broader impact on the Singapore capital market. Because you can see they have a lot of their revenue actually generated from tradings, from wealth management, and also other than these three banks, right? Talking about capital market activities, XGX, the Singapore Stock Exchange, also could be benefited. They are one of the most directly benefited from this as a Singapore's core market infrastructure provider. They are well capitalized to benefit from this. From increased fund flows, typically from higher turnover, trading turnover rates, uh, directly boosting clearing and trading fees, a key revenue driver for SGX. So we believe that they could be one of the biggest beneficiary from this, and beyond transactional income, a deeper market liquidity and strong valuations enhance SGX attractiveness as a venue for IPOs and secondary listing, supporting listing and annual fee income. So a more vibrant small and mid-cap landscape may also spur creation of Singapore-focused ETF, a broader index inclusion, and growing demand for proprietary data and analytics, laying the foundation and demand from products offered by SGX. So next, we move on to the second largest sector, REITs. Singapore REITs, yeah, normally when we talk about Singapore, all we know about is banks and the REITs, right? So REITs is one of it, the second largest sector, has grown into one of the largest of all because the country has deliberately positioned itself as a global hub for listed property trust. So its clear regulations, tax transparency, and strong governance framework has made it attractive destinations for both of domestic and foreign investors. So many of the Singapore REITs, right, actually own high quality assets such as prime buildings, shopping malls, hotels, logistic parks, and increasingly also data centers, which we can't find it in Malaysia yet. No, in Malaysia, there's no listed data center REITs yet, but we do have it in Singapore. So not only in Singapore, but also across Asia Pacific region, Europe and US, giving investors across access to those diversified real estate exposure through a single market. So the sector also benefits from Singapore's investors' appetite for steady dividend-paying instruments as REITs are required to distribute more than 90% of their taxable income. So compared to Hong Kong, right, where property developers dominated the market, the US, where REITs are more fragmented, Singapore offers a more concentrated, professionally managed REIT sector with some of the highest yields in the region, reinforcing its status as Asia's leading REIT hub. So we expect within REITs, right, we don't expect everyone to benefit. We more prefer industrial and logistic REITs, resilient. They are more resilient amid US tariffs and global trade tensions, and their direct exposure to the US remains relatively modest at around just 13% of total exports for the first 2 months for the year. And average 10-year average is around 11%. So while US bound trade might take a slight hit, the impact is likely to be less severe than experienced by regional peers such as Vietnam, Malaysia, or Indonesia. So this comparatively lighter tariff burden makes Singapore exports much more cost competitive, which may position the country as a stable and reliable trade partner in the eyes of US buyers. So this positioning could lead them to increase demand for logistic warehousing, higher amount of goods passing through in the free trade zones, and more investments in smart logistic and supply chain technologies. So another sector poised to benefit from this significant growth is also data center risk, which is like I mentioned, in Malaysia, we don't have any of it, although we have a lot of all those data center projects, data center projects announced that are in the making also, but none of the data center REITs in Malaysia yet because everything is just too new. All of the data centers, those big one especially, um, they're actually in the process of building or planning. They haven't started to operate yet. So it's hard to see a data center REITs yet. And also, right, those Malaysia, a lot of the data centers are not actually owned by Malaysia companies. So this is it. But Singapore, in contrast, they have access to all of this. So this is especially so with the increasing adoption of AI and cloud computing. You can see, right, yesterday, if you know about US markets, companies like Oracle, they released their earnings result. Share prices jumped more than 25% because their cloud demand was just so robust. Yeah, so this shows that AI strength continues, and AI applications such as ChatGPT and autonomous technology requires high density computing, which leads to higher power requirements per rack. So despite strong demand, right, data center in Singapore remains limited due to land and regulatory concern, including a moratorium on new DCs to manage energy consumption. So new DCs data centers must now meet more stringent energy efficiency standard before construction. And this is not just in the Singapore, right? I think data centers around the world is also facing this regulatory barrier that they need to upgrade it. They need to comply to more stringent energy efficiency standards. So this has prompted DC data center focus S-REITs to actually look for more markets opportunities across the world to find more investment to build more data centers, not just in the Singapore, right, to many parts of the world, such as North America, Europe, and Japan. For example, right, Mapletree Industrial Trust acquired data center assets in Osaka and Tokyo in 2023 to 2024. And globally, data center capacity is projected to grow around 15% per annum to until 2027, but it's still falling short of demand. So as sustainability becomes increasingly important, ESG compliant, they also become a key focus area, just like I mentioned. As REITs like the Capel DC REIT is also aligning with this trend. Its recent full acquisition of the Capel data center campus in Singapore includes infrastructure designed to reduce energy and water usage, reflecting a broader industry push towards green data center operations. So within our stock market, right, Capel DC REIT and Digital DC Core REIT are pure play DC, with our Maple Tree Industrial Trust, a diversified S REIT, has sizable exposure towards data centers. So with valuation seemingly attractive as the FTSE Singapore REITs index currently trades close to their standard deviation, their 10-year average forward PB ratio, and yield spread is actually, you can see on the chart on the right hand side, it has been improving since relative to their 2022 level. So an easy way to interpret this is with yield spread actually increases, right? This means that their yields are actually offered by the SG REITs are actually much more attractive. So investors may consider it as an opportune movement to actually build up positions in this sector. And within this sector, logistic REITs stand to remain resilient in light of the US trade tariff and global trade tensions, while data center REITs, as REITs will see strong AI-driven demand despite power and regulatory concerns. I know a lot of Malaysia, we have seen how data center can be crazy in Malaysia, especially towards companies like the construction companies, utilities companies, but all you want is just one data center REITs companies, but now Malaysia, we don't have it yet, so investors can consider to go towards Singapore, our neighbor country, to actually seek for this exposure. So that said, investors should remain watchful of the trade policy uncertainty, geopolitical risks, changing consumer trends that may impact it. And for S REITs, because of the higher for longer rates yields, right? We believe that a selective approach is the key, and we recommend investors to go for more focused, well-managed S REITs with resilient balance sheet and capability to capitalize on those structural tailwinds. So now let's move on to a not so popular sector, a smaller sector in Singapore, the Singapore properties. And within this sector, right, when we look at some of the potential beneficiaries from the EQDP program. Few companies has stand out. But first, if you see on the table on the left-hand side, top 10 performers, including Centurion and Singapore Land Group, which have delivered total returns between 13% to 88% year to date. So this is particularly interesting is that despite such a strong value, right, the sector is still trading at the price to NAV ratio below its historical average. More strikingly, it represents a steep 50% discount to its NAV. That's not common. That means it's very cheap. In other words, many property stocks are still very undervalued. This suggests that there are still potential room for potential upside, especially as greater investors' attention and liquidity, as supported by the EQTB program, help to close the gap. And based on our screening, one of the most underlooked gems could be, you can see the name, one of the name on the left-hand side, Hobby Land. Listed in Singapore since 1999, the company boasts a global portfolio spanning residential, commercial, and life science property. Locally, Hobby Land is best known as the developer of the Sentosa Cove and the Metropolis at one of the largest Grade A office development outside of Singapore CBD area. So an undervalued large developer is also UOL Group. The company owns a broad portfolio of residential, commercial, hospitality, including its hotel subsidiary, Pan Pacific Hotel Group, and a significant stake in Singland. So like many developers, right, this UOL Group trades at a significant discount against its price to NAV value. So you can see the two names I mentioned, they trade at a very, very discounted price to NAV value. So this means that from a valuation perspective, they continue to be very undervalued with further upside for fair value gains on investment properties and future redevelopment opportunities. The estimated RNAV should be significant higher, making UL Group as well as Hobbyland to see more valuable opportunity for investors. So especially you see Hobbyland is just traded at around 0.37 to their price of their price times of their price and to NAV below its 10-year average and 20-year averages. And so importantly, its reported NAV is very conservative. Development properties are carried at cost or the lower of cost of their net realization value, so just suggesting that some asset value is not reflected on the books. So low analyst coverage and limited trading liquidity has kept the stock under radar of most of the investors. But the launch of the EQDP could actually bring this company back to shine on undervalued mid-cap names like Hobbyland, so potentially unlocking up potential for re-rating. So this EQDP program can also be a catalyst for the Singapore oil and gas sector. So Singapore oil and gas sector has suffered a difficult decade, battered with by volatile crude oil prices, overcapacity, and a prolonged downturn in the industry activity. So as early as 2014, companies within the sector started to show signs of distress and crude oil prices tumbled from more than $100 to around 30 per barrel in 2016 due to global supply glut and a weaker than expected demand. So the oil price slump took a heavy toll on Singapore oil and gas companies as they grappled with a collapse in new orders and shrinking demand, which culminated in the demise of several high-profile names such as Weber in 2016. So the years that followed saw some more firms slide into financial distress, sparking a wave of bankruptcy and restructuring across the entire sector. So today, this sector is slow but a shadow of its former self, with many smaller players wipe out, leaving only a select few to carry on. So on the ones that survive have now focused on streamlining operation, reducing debt, and diversify their service offering to cater to evolving demand. So we see structural change towards restructuring towards their business models, their business plans. So looking ahead, right, sectors prospect are gradually much more improving, supported by stabilizing oil prices and renewed offshore investments for both non-renewable and renewable energy. So although a full recovery might take some time to actually materialize, companies that have weathered the downturn have become much more resilient and better positioned to capture the opportunities of rising energy demand. So moreover, the EQDP program actually gives this chance for them to shine, for these companies window to shine, to make a comeback after such many years of underperforming. So, as always, based on our selection approach, right, we filter out some of the companies here. Besides some of the general factors that I mentioned just now, right, we also look at qualitative factor because this sector is quite of challenging, comparing to because of what they have been facing on over the past, right? So we also look into some of the factors such as companies' business plans, earnings guidance, and other relevant metrics. So in this, we filter up a company called Marco Polo Marine, right? It is an integrated marine logistic company that has a long-standing presence in Asia's maritime sector. So the company operates in two core business segments, which is the chartering as well as shipbuilding and repairing. But more importantly, why we pick this company is because the management has decided to pivot the company's operation into towards the offshore wind industry, which is seen to be a much more stable and high growth market compared to a cyclical oil and gas industry. At first, the company repurposed its existing fleet to support the offshore wind industry, but in 2022, it has come up with its own commissioning service operation vessel. It's called a CSOV. That means they come up with for in simple terms, it's like a platform on top of the sea that helps that's designed to support construction and maintenance of offshore wind farms. So we could consensus are actually projecting earnings to grow at an average rate of around 20% over the next couple of years. And in terms of fundamentals, it is the Marco Polo Marine is actually the one of the best among its small to mid cap peers with low debt to equity ratio of close to 22%. So, as a matter of fact, the company is still at a net cash position, so underscoring its prudent financial strength. So although evaluation have risen as of late, but there's still potential for its share to appreciate further, given the if earnings momentum continues and demand for offshore wind sector strengthens. And last but not least, the last sector that I'll be mentioning today here is the semiconductor space. So well, our core recommendation has been the global semiconductor. There's an ETF called the SMH, the Value Semiconductor ETF, with broad exposure to global names. It is important to recognize Singapore's increasing strategic role in the global semiconductor supply chain. So the city state currently accounts for 5% of the global wafer fabrication capacity, 20% of the semiconductor equipment production, and also 10% of the total semiconductor output. So coupled with the EQDP, the program, right, which encourages investments beyond large cap, we screen these two companies that is expected to continue to deliver earnings CAGR of more than at least 10% for the next 3 years. And these two names, which is the UMS Integration and French Can. So notably, both companies reported stronger earnings and issued positive guidance on the back of tailwinds. So these stocks have also generated year-to-date total return of 38% and 30%. So first start with UMS. They are headquartered in Singapore. It's a one-stop strategic integration partner providing equipment manufacturing and engineering services to original equipment manufacturing, the OEM, of semiconductors and related products. So the company is in the business of front-end semiconductor manufacturing. So they are so-called the formulation. They are so-called the OSAT players. And comparing to our Malaysia, our very own OSAT player, which is Inari, right? UMS exposure towards the semiconductor space is actually even bigger because the largest customers is actually the applied materials and that is directly exposed to the global semiconductor cycle. So unless so this position themselves as more closer to towards the global semiconductor play, and they have also new facilities in Penang, position themselves as a key beneficiary of the ongoing shift in global supply chain. And also, just now I mentioned Applied Materials, right? Their another largest customer is also Lam Research. So both of these company have been positioned this UMS as actually one of the bigger beneficiary compared to a lot of the Malaysia companies, which we don't have actually very direct exposure towards global semiconductor space. So, but then good news is UMS integration. They are also listed in Malaysia and it's just listed recently. But on the other hand, French Can Group is a diversified global engineering company that provides a wide spectrum of high-value manufacturing and engineering services that to leading multinational clients. So they have two business segments. The largest one is the mechatronics, made up of 90% of their revenue, and integrated manufacturing services making up of the remaining one. So they are a diversified global engineering company that provides a wide spectrum of high value manufacturing and engineering services to leading multinational clients. So this and they are also at the ATE space. So with that, basically come to an end of some of these sectors over here. And for unit trust, right, you can consider these two funds that we have available currently in our platform. So such as the Amoa Singapore Dividend Equity Fund and Principal Singapore Equity Fund. So how you differentiate them is that Amoa Singapore Dividend Equity Fund is they are more dividend oriented play and they pay income distributions. You can think in of like a dividend distribution in a unit trust type and they pay monthly. That means every month you get a payment from this unit trust. Whereas Principal Singapore Equity Fund, they are more towards like more growth oriented. So they are more volatile, but they have more potential for upside as well. So these are some of the breakdown of their fund holdings as well as sector allocation. Yeah, you can see. So this is some of the key takeaway. Over here, you can take a picture or yeah. So before we and this with this, I've come to an end to my sharing here today. And we hopefully we can see you in our next webinars too. So next, we will go into the uh, we okay, so to end before we really end this, right? We need to shout out of our campaign that we are running here. Today is the SGX campaign with zero fee, and it's ending on 19th of September. So yeah, so lastly, before we really end, I see a question in the chat box, right? Could you please share the target price of our recommended SG stock? So currently we don't actually have exact target price for some of the stocks. We just it's just fall into our criteria that we view it as some of the potential beneficiaries of the EQDP program. But actually a lot of these companies have many of these companies has run beyond their actual fair value already. But it's just that we are actually seeing more flows into these markets, this market, right? So we see these companies as one of the major beneficiaries. But as always, you need to be very careful when you actually invest, when you actually make your investments because of their volatile nature. As well as they are very dependent on liquidity. Once liquidity dried up, then we could see there might be impact towards their share prices. Yeah, so with that, I basically, is there any more question? So if not, we have basically come to the end of our sharing here today. So just to remind you guys that we are running the SGX campaign ending 19 September. So happy investing and we'll see you in our next webinar. Thank you.